Ryan Detrick, Chief Market Strategist at Carson Group. Thanks for joining us today.
Thank you for having me. It's nice to see some green out there.
It is. What does today's CPI number mean for the Fed's roadmap for the rate? What do you think?
Yeah, great question there, because obviously it's what we've seen in the past. And we know inflation really wasn't a problem. The Fed has said that itself. It's the uncertainty over tariffs. That's why the Fed's not cutting. We were in the camp the Fed probably should have been cutting early this year or later last year. They didn't do it. Now they're kind of in this hard spot. But, it slightly says maybe there's a better chance of cuts coming. But the reality is, what's the market telling us? I mean, the market's saying, listen, with all this tariff stuff, if we can get through this, maybe the economy is going to start to expand. And I'll be honest, I didn't think yields would be going up like they have been lately, with the market simply soaring. But that's where we are. So the market's saying, hey, maybe the economy is going to be better second half of this year, and maybe we don't need as many cuts. And that might be an okay thing for investors out there.
Okay, so let's talk about U.S. and China first, because they've paused tariffs for the most part. But could you see some of that market optimism we saw on Monday subside if those trade talks don't properly materialize or go well?
Yeah, I mean, clearly it could change in a hurry. We know it's, I think, what we call it a fluid situation. So, that's always possible. And listen, all the same people that were telling us we're going into recession a month ago and we're cutting their targets, all of a sudden now everybody's starting to up their S&P 500 targets and pushing down the odds of a recession. We get it. It's confusing out there. But the reality, again, is, listen, we just had an earnings season that was better than expected. We've got a slowing economy. Yes, one that's cratering and just crashing to a stop. No, we don't think so. I mean, listen, initial claims in the United States are still fairly low. We're not seeing layoffs yet. I mean, things aren't perfect. There are cracks out there, but the economy is doing pretty good, all things considered, in our view. Okay, so let's get to earnings. What are you seeing there that you like? Yeah, listen, the Mag 7 did really well, right? Tesla didn't do as well. The other ones did. So you look at that, all that bearishness coming in, the big guys did really well, but just high level. On March 31st, when we came into this year, S&P 500 earnings were expected to be up about 6.5% year over year. Okay, what's that mean? It's coming in like 13.5%, double that. And yes, that's what you did lately. Guidance is murky at best, but I think that's another reason why we are seeing a historic rally over the past 4 or 5 weeks approximately, because all the worst stuff we are being promised by so many people, fortunately, is not happening. And earnings are just another sign that, it's not great out there, but it's better than we were pricing in, and markets are all about expectations. But is that because you think a lot of it hasn't worked through the guidance, right? They're pulling their guidance, or they're changing their guidance, even with inflation. Is it just because we haven't had that actual hit from the tariffs going on and off? No, you're right. We haven't had to hit yet. I mean, we haven't had hit a lot of different places. When you look at, inflation, like we said, no, not yet. Maybe it could come. With initial claims, there are told to be all these layoffs. We haven't seen it yet. Even with the consumer, I mean, the consumer, at least the U.S., bought a lot of stuff last month. Yes, they did it likely because they're buying ahead of potential higher prices. We understand that. So those things are all there. At the same time, listen, market is up on the year. We can get into that stuff. I mean, the S&P's up on the year, and really we think this momentum that we're seeing from a pure markets point of view is legit, and we still think there's some better times coming for investors. Well, I was going to ask you, Ryan, because a lot of investors, as you know, got scared, got panicked, didn't know what was going on. Things were changing hourly out of Washington. Do you think they've sort of missed the opportunity? Obviously, they've missed some of a rebound, but have they missed an opportunity overall for a rebound, or do you see upside for them later on? Well, we see more upside, but listen, I get to work with financial advisors every day and their clients, and the honest truth, a lot of people, friends and family I know, a lot of people after that 10% drop in 2 days after Liberation Day couldn't take it anymore. A lot of people sold, a lot of people panicked, and then you have this beach ball effect with the ball way under the water, and now we've had this incredible rally just in the last several weeks. That is, it's unfortunate. I mean, we said this year was not going to be the first year in history we came in without any scary headlines, without any volatility. Every year you have that. Yes, we had a near bear market in the United States. We know it was very uncomfortable is the word I'm going to use for a lot of people, but that's investing. Last comment at our team, we like to say, volatility is the toll you pay to invest. If you want the gains, you have to put up with the volatility. And a lot of times investors have trouble doing that, unfortunately.
How often does near bear become bear?
Yeah, that's a great question. So if you look in history, we've had a handful of those 19% near bear markets. Yes, we've had a lot of bear markets in history too. But I like to say this, all bear markets start as a correction, but not all corrections become a bear market. We found like maybe 25% or so of all the times you went into a correction, it's down 10%. Do you go into a bear market? But even then, just recent history, 1978 to 1998, 2011, and 2018, all times the S&P pulled back right around 19%, really close to that magical 20, got everybody all bared up, and then you rally, and once again, it's looking like history repeated itself once again with another 19% near bear market, and now we've come a long way off that, fortunately.
So a lot of investors, as you know, were either sort of looking to Europe or pivoting towards Europe or other markets outside of North America because of what was happening in North America. Would you change those positions at this point because you feel strongly that the U.S. is coming back and will continue on the upside, or would you still sort of hang on to your positions outside of North America?
Well, what we're doing with the models we run for our Carson partners, we have a decent amount of European exposure, specifically Europe. I guess it's called developed international, specifically Europe. We've added that kind of all year at different times. Are we still overweight equities? Yes, we are. But again, we've got a big chunk of that in that developed international European markets, which is, hey, we think that's good. I mean, the whole time when you had Germany like hitting all-time highs and U.S. way down here, we thought U.S. would probably play catch up with a lot of those European countries that are doing well. We're starting to see that. But again, when in doubt, diversify it out is something we like to say. And there is a lot of doubt and confusion out there. So the last couple of years, I came on with you guys saying, listen, this is a bull market. You want to be in the U.S. We've kind of changed our tune a little bit. It's still a bull market, but more of a global bull market with diversification really working. So there's nothing wrong with having, again, a U.S. investor, and listeners to your program might not be all U.S. investors, but we've got a good amount of U.S. Equities. Don't get me wrong, but there's a lot of other parts around the globe that are looking really good. And we still think they'll do pretty good the rest of this year.
Ryan Detrick, I've got to leave it there, sir, but appreciate you joining us. Ryan is a chief market strategist at Carson Group.